Ever heard of the famous nickname Startup Nation? Once in a state of war, facing limited natural resources and high inflation rates, there is this small nation that has transformed into a hub of technological advancement. Its GDP has surpassed nations such as the UAE since 2020. This country is Israel, born in 1948 and located in the Middle East, with a population of 9.75 million people as of 2023. Over the years, Israel has faced numerous challenges, such as a difficult relationship with its neighbors, spending a large portion of its national budget on defense, limited access to global trade due to being located near the ocean, and an overall lack of natural resources such as oil. Despite all of this, Israel seems to be thriving. So let's uncover what is the secret to Israel's economic success, and how did this small country achieve it so quickly? Decades ago, Israel's economy faced challenges similar to those countries like Turkey, Lebanon, and Sri Lanka face now. Political unrest hindered economic growth, and there was high inflation and a general lack of confidence in the economy. Overcoming these difficulties was very challenging, but Israel managed to do so. Israel's annual growth rate averaged around 3.8% from the years 1996 until 2024. To put Israel's growth rates into perspective, the country's GDP was a mere $25.3 billion in 1980, and it has grown ever since. In 1990, Israel's GDP reached a remarkable $61.7 billion, more than $35 billion higher than the previous decade. Today, its GDP is $509.9 billion as of 2023. According to the IMF, Israel's GDP is projected to reach $530 billion in 2024. The growth is simply astounding. Many would think the EU and UK's GDP per capita is high. But who would thought Israel's GDP per capita is higher, ranging around a staggering $52,262 in 2023, compared to the EU average of $40,824 and the UK average of $48,867 in the same year. When talking about Israel's exports and imports, Israel imported $106.3 billion worth of goods from around the world in 2022. As for 2022, Israel exported a total of $76.9 billion worth of goods. This resulted in a negative trade balance in terms of goods, with Israel importing $30 billion worth of goods compared to its exports in 2022. The top 5 imports of Israel included energy imports such as fuels, raw materials, consumer goods, and investment goods. As for Israel's services imports, they totaled $43.3 billion in 2022 and represented 29% of total trade in goods and services. Despite the trade imbalance, Israel has significantly increased its exports. One of the key factors for Israel to increase its exports is its ability to access foreign markets. Israel has established free trade deals with the European Union and the United States, and it is part of the World Trade Organization. Due to these agreements and Israel's numerous advancements in tech industry and science, the country has been able to engage in successful trade, even though it lacks access to markets in the Middle East. Israel has also diversified its exports. Now, Israel exports items like integrated circuits, refined petroleum, and medical instruments. Its advancement in the tech industry also led to the drip irrigation and water desalination plant technologies that are now sold globally. As a result, over the last 5 years, Israel's exports have grown by $15.6 billion, from $61.3 billion in 2017 to $76.9 billion in 2022. So what's the secret to Israel's economic success? This result is a combination of various factors. The absence of natural resources has driven its inhabitants to seek alternative solutions, such as its incredible tech industry and thriving tourism sector. Additionally, Israel has successfully assimilated large waves of Jewish immigrants that has had a large impact on the nation. However, Israel was able to benefit from these immigrants even though they had a few difficulties at first. Israel witnessed its most significant period of immigration between 1948 and 1951. Over the course of 3.5 years, 688,000 immigrants arrived in the country, approximately 200,000 per year on average. At the time of the state's establishment, there were approximately 650,000 Jews living in Israel, so this inflow effectively doubled the Jewish population. The new state was now faced with a sizable population that largely lacked agricultural or modern professional skills. The impact of immigration was so substantial that the Israeli government enforced a resource rationing in the early 50s, including oil and food. This era, referred to as the austerity period, witnessed governmental regulation of prices and allocation of essential goods to handle limited resources. Despite the difficulties, Israel achieved notable economic expansion. Between 1950 and 1955, the economy expanded at a rate of approximately 13% per year, and at just under 10% in the subsequent years leading into the 1960s. So how did Israel manage to do that? Immigrants greatly expanded Israel's labor force, and the labor force was crucial for developing its agricultural sector, which boosted food production, alleviating the food rationing pressure. The labor force also accommodated the construction boom, contributing to the country's infrastructure development. This is driven by the government initiatives to build new towns and infrastructure, creating jobs and contributing to economic growth. It was a win-win for both the country and the immigrants. Education was provided to these immigrants by the government, which laid the foundation for Israel's future success in technology and innovation. What made all these possible was financial aid provided by the Jewish community abroad, such as the U.S. via its Jewish Agency and the United Jewish Appeal, which channeled billions of dollars into Israel's economy. There was also the reparations agreement signed with West Germany in 1952, resulting in payment of around $714 million at that time, equivalent to more than $8 billion today. The reparation was a result of the Holocaust, a genocide of Jews during World War II, and the funds were used to finance infrastructure projects for the resettlement of Holocaust survivors who had immigrated to Israel. The influx of immigrants to Israel didn't stop, and the collapse of the Soviet Union in late 1991 facilitated this process. About 190,000 Jews arrived in Israel in 1990 and 150,000 in 1991. However, as conditions in the former Soviet Union stabilized and immigrants faced difficulties adjusting to life in Israel, the immigration rates leveled off at around 70,000 per year. From 1989 to the end of 2003, over 950,000 Jews from the former Soviet Union had settled in Israel. The Soviet immigrants brought with them a high level of education and professional expertise. Many were scientists, engineers, doctors, academics, and highly skilled professionals that had been trained in the rigorous educational systems of the Soviet Union. This influx of skilled immigrants coincided with the global rise of the information technology and telecommunications sectors. They became the key contributors in founding tech startups, research and development, and filling roles in emerging industries such as software development, electronics, and biotechnology. These immigrant skills were crucial in driving innovation and supporting the growth of Israel's technology sector, which would later earn the country the nickname Startup Nation. Israel's economic freedom had historically fallen below the global average until the mid-1990s. However, during the period of significant migration, Israel increased its economic freedom score by 45%. In 1995, it had exceeded the worldwide average in economic freedom, and by 2000, it had risen by 38 positions to reach the 54th freest rank, proving that Israel is an example where mass migration did not harm institutions, despite the fears of many prominent social scientists that such migration would. However, Israel faced an extraordinary inflation crisis in the 1970s, with inflation rates consistently exceeding 30%, far surpassing developed countries after the Ukrainian War. That's not the end of it. Inflation eventually peaked in 1984, when it soared close to 400%, a rate even higher than the hyperinflation experienced by Venezuela in 2015. The inflationary process in Israel over the 1970s to 1985 was influenced by many intricate and complex factors, which I could not hope to explain all of them in this single video. But let's explore a few key ones that are notable. One of the most obvious root causes of this rampant inflation was the Israeli government's persistent overspending. In the 1970s, government expenditures exceeded 76% of GDP, far beyond what the economy could sustain. To finance this excessive spending, the government resorted to printing money, a strategy reminiscent of Venezuela's approach during its own economic crisis. The substantial defense burden, accounting for roughly 1/4 of Israel's GNP since the Yom Kippur War in October 1973, was a major factor contributing to inflation. This conflict, involving Israel and a coalition of Arab nations including Egypt and Syria, led to about 1/3 of Israel's debt repayment obligations being tied to defense. Domestic defense spending is also underestimated, as accurately assessing the economic impact of redirecting manpower and resources toward defense efforts proved to be challenging to quantify. The war also led to the oil crises in the 1970s, which severely impacted Israel's economy. The country faced higher import costs due to the global stagflation, leading to an increase in the prices of goods and services, which further fed the overall inflation of the country. To put things into perspective, 1 barrel of oil in 1973 was at $18.90 and climbed up to $111.30 in 1979. Inflation in Israel was also driven by a wage price spiral, where rising prices led to demands for higher wages, which in turn led to further price increases. This cycle was fueled by strong labor unions that secured wage increases to keep up with inflation, which then passed on higher costs to consumers. And it doesn't help when many wages and contracts in Israel were indexed to inflation. While this helped protect individuals and businesses from the immediate effects of inflation, it also perpetuated inflation by automatically adjusting wages and prices upwards in response to previous price increases, creating a self-reinforcing cycle. Take a look at this photo. The man on the screen is the savior of Israel's economy in the mid-1980s. Shimon Peres, who ascended to be Israel's prime minister in 1984, was determined to combat the hyperinflation that was crippling the country. Peres went on to implement the Economic Stabilization Program. The first measure was that the government implemented strict financial controls by drastically reducing excessive spending on welfare, government jobs, and infrastructure projects. By cutting these expenditures, both individuals and businesses that previously relied on this income no longer received it. With less money circulating in the economy, the currency became scarcer and more valuable, helping to curb inflation. This fiscal discipline significantly reduced inflationary pressures and limited the excessive printing of money. As a result, the fiscal deficit as a percent of GDP, which had averaged over 10%, transformed into a surplus exceeding 2% following Peres's reforms. However, fiscal control alone was not sufficient. Israel's economy in the 1980s was heavily dollarized, with only 3% of bank deposits denominated in shekels, the local currency. Years of galloping inflation had eroded public confidence in the shekel, leading most people in the country to resort to using foreign currencies such as US dollars. To address this, Peres took the bold step of granting independence to the Central Bank of Israel. Until then, the central bank had been under government control, allowing previous administrations to spend recklessly and fuel inflation. By making the central bank independent, Peres ensured that future governments could not easily trigger inflation by returning to unsustainable spending practices. And the most obvious move the central bank could do to counter inflation is by controlling the money supply and increasing interest rates to preserve the value of the shekels. This move restored confidence in the shekel, with the percentage of bank deposits denominated in shekels increasing from 3% in 1984 to 38% by 2002. Peres was also able to bring different sectors of Israeli society together to agree on a social contract aimed at controlling inflation by aligning future price expectations. He was a skilled negotiator, able to reach an agreement with the Histadrut, Israel's largest labor union, to implement a wage freeze with predetermined monthly increments that match the government's inflationary goals. By the end of the 1980s, inflation had returned from 400% in 1984 to a low 20% in 1986, and most trade within the country was conducted in shekels once again. The stabilization plan had successfully restored economic stability. With the inflation rates down, Israel started to work on growing its economy. Their initial rise came from offshore natural gas. This discovery had a significant impact on the energy industry. The identification of additional major natural gas reserves in Israel since 2009, such as Tamar and Leviathan, has turned the Jewish nation from an energy-dependent country into a supplier of energy, both domestically and internationally. The discovery of natural gas resources in Israel's offshore regions has significantly strengthened the country's energy security. Concurrently, energy consumption from coal has dropped by more than half. The natural gas industry is anticipated to provide ongoing economic advantages, with predictions suggesting that an additional $18.5 billion, about 70 billion new Israel shekel, will be contributed to the state's funds from natural gas by 2030. When combined with previous payments, this additional income is expected to total around $23.8 billion, about 90 billion new Israel shekel, by 2030. The country has saved over $83.7 billion over the past decade due to natural gas production. Israel also benefits from tourism. The economy of Israel being stable, as well as continuous investments in infrastructure development, all have played a role in expanding the travel and tourism industry. As a result, the economic significance of tourism in Israel has been growing in recent times. Tel Aviv, Jerusalem, and Haifa are renowned tourist spots in Israel. Nevertheless, the country's natural and historical attractions also draw large numbers of visitors. In 2021, the Israeli Nature and Parks Authority recorded more than 2.5 million visits to historical sites in Israel. Recorded in 2022, historical sites in Israel saw over 4.1 million visits, marking a nearly 70% increase from the year before. This also marks nearly one foreign visitor with every 2 citizens, as the country's population is about 9 million. Tourism significantly contributes to Israel's economy. According to the 2023 Israel tourism income data, there was an increase to $5.9 billion from $5.5 billion in 2022. An Open Skies Agreement was established between Israel and the EU in 2013. leading to an increase in inbound and outbound tourism as new European airlines began operating in Israeli airports. The overall financial contribution from tourism is projected to reach almost $30 million by 2025, marking a new record high. What really pushed Israel's economic rise is its high technology sector, which has experienced the most rapid growth compared to all other industries in the past 10 years. In only a single year, Israeli startups secured an all-time high of $4.8 billion from investors, and high-tech and startup firms were acquired or went public for a total of $10.02 billion in 2016. Israel has become a prominent innovator in recent years, while its neighboring Arab countries primarily focus on oil production. That is why Israel is often referred to as the Start-up Nation, or Silicon Wadi, which is the Middle Eastern equivalent of California's Silicon Valley. Israel is akin to a giant tech incubator, continuously generating new ideas at an unprecedented pace. Tel Aviv is often seen as Israel's main economic and cultural center. Thanks to the city's diverse and lively atmosphere and its continuous focus on innovation, Tel Aviv has positioned itself as a hub for startups, both locally and internationally. According to the IVC Research Center, there were 1,363 startups in Tel Aviv in 2021. As for the economic impact of technology, the Israeli high-tech industry contributes 18% to the local GDP, compared to less than 10% in the US and around 6% in the EU. Approximately 14% of the workforce is employed in the high-tech sector and in technology-related positions in other industries. The Israeli economy is heavily dependent on high-tech exports, which account for about 50% of total exports, along with high-tech taxes. Before we get into the last part of the video, make sure to check out the link in the description for my best recommendation when it comes to further expanding our knowledge on a more personal scale. So how did Israel manage to become a high-tech country without any prior experience in this field? The Middle Eastern state started its high-tech journey during a period in which the Israeli economy heavily depended on government funding. An initiative called Yozma used public funds to attract private investment, resulting in Israel evolving into a global hub for research and development. Yozma, which was active from 1993 to 1998, enabled foreign investment to flow into Israeli businesses using public funds. Yozma's strategy of attracting foreign investors to Israel through joint funds led to establishing over 30 foreign-based venture capital firms in the country. The Yozma program focused on creating investment funds by combining public and private funds to support Israeli startups. According to its main model, the government initiative would contribute up to 40% of the capital raised by external investors. This contribution would be redeemed with interest at the same value within 7 years. Yozma provided substantial tax benefits and matched investment pledges to international VC investors. Despite the existence of VC funds in the 1980s, it was Yozma that truly catalyzed the development of Israel's venture capital sector. From 1991 to 2000, Israel's yearly venture capital investments surged from $58 million to $3.3 billion. By 1999, Israel became the second largest investor in private equity through venture capital, and it held the top rank in the world for its share of growth from high-tech ventures. Yozma has overseen over $220 million in its 3 funds since its establishment. Yozma 1 was created in 1993, followed by Yozma 2 in 1998, and Yozma 3 in 2002. The company has made direct investments in approximately 50 portfolio companies. It's worth noting that the number of startups founded in Israel increased from 2,500 in 2000 to 3,800 in 2005. Yozma has played a key role in supporting many of its portfolio companies to become publicly listed on major stock exchanges in the US and Europe. The group has a strong focus on life sciences and technology and has established close working partnerships with universities and research institutions. It is safe to say that Israel has achieved many accomplishments despite being only in its mid-70s. All in all, Israel's economic miracle stands as a remarkable testament to resilience and innovation. Despite facing numerous challenges, the country has achieved significant economic growth, surpassing expectations and transforming into a hub of technological advancement. That is all we have for today. If you like this video, make sure to give us a big thumbs up, subscribe to our channel, and turn on the notifications. And if you want to continue exploring the different economic landscape in the world, you might be interested in this video on the screen. Thanks for watching, and we will see you next time.